Hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Very good morning. Today will be Tuesday, the 3rd of June 2025. So, as usual, before we jump straight into the gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so give me a minute. Let me just to make sure that the screen is good. Yeah, I think it should be fine. Okay, one second. Yeah, it should be working. All right, so as usual, before we jump straight into the intraday short-term technical outlook on those broad-based cross-asset classes, i.e. the major US dollar pair, the major stock indices, and as well as the two key commodities, gold XAU/USD and West Texas crude oil that we covered on a daily basis, let's have a quick recap what has taken shape yesterday in terms of economic data, news flow, and as well as their impact on their various respective broad-based cross-asset classes, and also as well as any key data or news flow that has taken shape early in today's Asia session that could impact the broad-based cross-asset classes before the start of today's daily dose at 11 a.m. Singapore time. So yesterday was actually a kind of a sell America day, but in terms of asset classes, will be primarily focused on the dollar weakness, moving in line with the US Treasury bond prices that is so inching downwards. So what do I mean by this? So what if you could see on my screen over here, okay. So what we could see is that the dollar continues to plunge. All right, so yesterday the US dollar index inched down by negative 0.7% and almost hit a 6-week low, looking to retest the 21st of April swing low area at around the 98 figure level. All right, so this push down in the US dollar correspond with the push up in the longer tenure US Treasury yield. All right, so this is the 30-year managed to stage a bounce right after a pullback retest at the 20-day moving average, inching back up towards the 5% psychological level. So what I could see over here is that in the last few sessions since last week, we see a tepid rise in the longer term 30-year US Treasury yield, indicating that market participants now are not in favor or not in demand of owning longer tenure US Treasury bonds. So bear in mind that bond yields rise, bond prices fall. So what it means that right now we start to see the resurgence of this sell America team play back, but more focusing on two asset classes. The dollar, the FX market, which is start to see a broad-based weakness in dollar starting from late last week, yesterday, spreading into yesterday, which is the start of a brand new trading month of June, and moving in line with the sell-off in longer tenure US Treasury bonds as well, as the 30-year Treasury yield continue to spike up towards the psychological 5% level. All right, and also the reason why the dollar sold off yesterday is right now we start to see not even US China trade tension, but now EU US trade tension coming back into the forefront as well. As yesterday there's this news flow out, EU warns that it could accelerate the rhetoric tariffs over US duties. So right now we know that both EU and US officials are in the progress or in the process, I would say, of negotiating the trade talks, but apparently the trade talks, the trade deal talks, seems to be moving a kind of a hit block where time is running out over here with that 9th of July headline deadline that is coming up, all right, with a deadline of 9th of July to reach a mutually acceptable solution. So what's this 9th of July? This 9th of July is where it will be the expiry date of higher reciprocal trade tariffs with US against the rest of the world. All right, so still recall that somewhere around in April, Trump actually kind of chicken out and he do a 90-day pause to temporarily pause the higher reciprocal rates, tariff rates against other currency while against other country, pardon me, while maintaining the base line of that 10% tariffs. All right. So right now, in the last few days, Trump threatened EU, stating that he will up the tariffs to 50% with a deadline in June instead. He will actually bring forward the deadline, but after kind of a so-called cool down by him, he decided to keep the deadline at 9th of July. But yesterday news flow seems to us that out from EU, that particular so-called talks between EU and US officials seems to be heading a roadblock, where EU warned that if nothing turns out rosy in the end, EU could actually implement a tit-for-tat measures imposing retaliatory tariffs over US goods heading into EU. So that also kickstart a sell America team play in the FX market and as well as in the treasuries market. Then what's interesting over here is that this South America tariffs, this South America team play is not prevalent in the major US stock market. That means, i.e., it did not hit the US stock market yesterday. And what's interesting is that the US stock market managed to recover earlier losses. So the S&P initially was in the red on the intraday basis, and at the right after the 10 p.m. mark Singapore time, market continues to rally strongly and close in the green. So the top performer yesterday is the Nasdaq 100, up by 0.7%. The Dow Jones underperformed almost unchanged at 0.08. The Russell 2000 up marginally at 0.19%. And we still recall yesterday the Nasdaq 100 in our CFD index, there's a key resistance level to watch, which is 21,500. So the rally exactly stopped at that 21,500 level. Which is our short-term pivotal resistance level, and we flip to a neutrality stance on the Dow Jones Industrial Average, expecting it to trade within a tight range, which indeed it did, all right, where it go neither nowhere yesterday on the intraday basis. So what are the key levels to watch out for and the trend bias for today on the Nasdaq 100 and the Dow Jones Industrial Average, which is the US Wall Street CFD index in our platform? Stay tuned for my second segment where I cover the intraday technical outlook. So now back to the first segment is why the US major stock indices did not have that negative feedback loop from South America team play is because of this trade deal tension de-escalation optimism coming back into the picture again over here, where there's a White House, we call it a press release, all right? So President Donald Trump and China leader Xi Jinping will likely speak this week, White House Press Secretary Caroline Leavitt said on Monday. So that kind of toned down the South America team play in the US stock market yesterday. Right. So whether will it be true, I think we got to take things one step at a time. So we know that things are pretty fluid. Things can change at any second based on the current US White House style of erratic way of implementing their trade tariffs policy. So then the next news coming up from early today Asia session is that yesterday we know that we see a steep sell off in the US dollar against the major currency, and as we are speaking right now, the dollar weakness managed to do a bit of pullback or corrective rebound. So we start to see the dollar recovering some lost ground yesterday, where the dollar yen managed to stage a bounce. I could see over here. So this is a 5-day rolling performance of the major currency as of today, 3rd of June. So if you do the 1-day rolling performance, we start to see the dollar yen bouncing pretty strongly earlier on in the start of today's Asia session, where it is up by 0.28%. Right, and what we could see over here is that the bounce in the dollar yen also led to the rebound that is being seen across other major currency as well. So how come as we are speaking right now, there's this so-called mini dollar strength that is playing out in the FX market is all due to about an hour ago, we have a Bank of Japan governor speech in the Japanese parliament. He actually signals that readiness to rise rate if and only Japanese growth reaccelerate. So it seems to us that his speech itself is stating that there's not much confidence that Japanese GDP growth could accelerate this fiscal year. There could be a potential slowdown in Japan GDP growth, uh, provide due to that trade tariffs uncertainty that US has against the rest of the world. So market view this as a kind of a dovish speech by BOJ, and short-term speculators starts to trim off yesterday's short position in the dollar yen, and that potentially lead to this mini bounce on this dollar yen. So will this mini bounce in the dollar yen translate into a potential start of a new dollar yen strength, that means i.e. new US dollar strength across the board? I will touch on again on my second segment of today's daily dose, which is the intraday technical outlook. And one thing for sure over here is that due to this uncertainty surrounding this situation right now between US-China trade relation, and right now EU-US trade relation, and also on top there's some geopolitical tension coming back into the picture where this Russia-Ukraine peace talks is going nowhere. Gold managed to actually outperform yesterday. All right, so what you could see, gold itself, we have been bullish since last week, where price action hit a key inflection level, which is the 50-day and the 20-day moving average, I think as key short and medium term support level. Gold yesterday did a rocketed up by 2.8% yesterday, 2.8%, and it finally broke out above this minor bullish flag formation since 23rd of May all the way down to 30th of May. So it's about 5 trading days where price action starts to get congested, but holding above the 20-day moving average, and it did that bullish breakout. So we know that after a strong bullish candle breakout, there could be a potential minor pullback. And given the fact that gold yesterday hit right exactly at our short-term resistance level, as we highlighted yesterday. So what is the pullback level to watch, and what is the new key pivotal support level to watch for today on the intraday basis? I will also cover later in my second segment of today's daily dose. So what you could see over here is that yesterday's gold rally is actually being supported by this Sell America team play as well. And right now, as we are speaking, gold is actually staging a pullback, which is pretty much normal after a very strong daily bullish Marubozu candle that we see yesterday, which is gold is now down negative 0.4%. We're also moving in line with that minor dollar bounce that I mentioned to you guys earlier at the start of today's Asia session, triggered off by BOJ governor rather dovish speech that he has in the Japanese parliament 1 hour ago. All right, so then another news flow is more pertaining to economic data for the US yesterday. So yesterday economic data out in the US is that ISM manufacturing PMI data. So ISM manufacturing PMI data is considered as a tier 1 economic data in the US to assess the health of the manufacturing services in the US. And why is it tier 1? Because it's leading, as this is soft data which is survey based. So anything that's survey based tends to tease or gauge the sentiment of the survey respondents over here, rather than hard data that has really taken shape in the past. All right, so for ISM services manufacturing PMI, it continues to point to a rather contractionary growth environment. That means it's a growth contraction accelerating. All right, anything that is below 50 represent contraction, and this contraction deepened in the month of May to inch down lower to 48.5, 2 basis points below 48.7, and below market expectation of 49.5. But what thing that is kind of a consolidating is the input prices starts to slow down slightly. So ISM manufacturing prices or input prices is a subcomponent of the manufacturing PMI data. So these manufacturing prices implies the cost of business in the manufacturing sector in the US. So we know that the cost of business input prices has been rising pretty rapidly since the start of this year, given rise also increasing the risk of stagflationary environment in the US due to all this uncertainty and haphazard and erratic way of US tariff policy implementation. So if you look at the subcomponent, this ISM manufacturing prices paid trend. Okay, give me a couple of seconds. So it seems to be hanging right now. I can't show you guys. Okay, good. It's finally out. Okay, so if you look at the 10-year trend, okay, prices is accelerating since the start of this year. All right, over here. So yesterday there's a bit of consolidation, a bit of breather, I would say. It managed to slow down to 69.4 from the previous month of 69.8 in April, and also slightly below market expectation of 70.2. Excuse me. And another data I want to share with you guys is from the privately compiled China manufacturing PMI compiled by the news called the news media Caixin. So Caixin manufacturing PMI is slightly different from the government compiled MBS manufacturing PMI. The Caixin PMI manufacturing PMI consists of SME, all right, whereas the government compiled MBS manufacturing only touch on more on the bigger state-owned enterprise. So the Caixin manufacturing PMI suddenly slipped into a contractionary mode to 48.3 from the previous 2 months, where it continues to expand in a very tepid rate at 50.4, and also way below market expectation of 50.6. So right now, the manufacturing sector in the Chinese economy that consists of the small medium enterprise right now is now showing signs of economic uncertainty. That means, i.e., it is a leading signal that China growth could potentially slow down in the Q2 and Q3 based on this leading Caixin manufacturing PMI tier 1 economic data for China. So what it is that it declined unexpectedly to 48.3 in May, down from 50.4, missing forecast of 50.6, and it marks the first contraction in the manufacturing sector in 8 months, and is the steepest decline since September 2022 over here. So what you could see is there's a growth deceleration. So that doesn't gel well to the state of the Chinese economy, and with that, this leading economic indicator could potentially prompt China policymaker to fast forward their so-called over the last 1 to 2 months, their promise forceful fiscal stimulus plans or policy to negate this negative impact from US trade tariffs. So with this so right now I could see over here is that the weaker the China tier 1 data, potentially it will lead to a positive feedback loop into the Chinese stock market and its related international watch market, which is the Hong Kong major benchmark stock indices, because market tends to be forward looking, and it anticipate much more fiscal stimulus measure that could potentially be bring forward by top China policymakers. So as we are speaking right now, the Hang Seng index actually recovered up 1.4%. The high beta China big tech stocks, which is being being gauged by the Hang Seng Tech Index, is up 0.8%, and the H shares, the HSCI, is up 1.5%, and the mainland China A shares that is being monitored by me, which is I use the CSI 300 benchmark stock index, comprises the health of the China's A shares market, is up by 0.56%. All right, so that's covered the first segment of today's daily dose. Let us now touch on the second segment, which is the intraday technical outlook on these broad-based cross asset classes. So let me expand my screen. All right, over here. So let us start with the FX market first. Over here. Okay, so the screen is good. All right. Okay, so let us start with the FX market. Over to the euro dollar. So the euro dollar, as expected, hit our first resistance level and almost come close to the second resistance level at 1.1480 over here. So what we could see is that upon hitting the first resistance level, RSI came to the overbought level, and right now it has exited from the overbought level, indicating a high chance of a pullback at the start of the European session. So with that, we will tighten our short-term pivotal support level for today at 113.74 to potentially hold this pullback. So as long as the minor pullback didn't surpass below 113.75, which is potentially a very psychological level in the short term. Why do I say that? because on the 27th of May, it tested 137.75 and did that significant minor sell off, hitting close to the 50-day moving average before bouncing back up, recover. On Friday itself, at the start of the Asia session, it faced a roadblock at 113.75, did a minor pullback, and finally during Monday, it managed to stage that bullish breakout in the European session. All right, so very clearly, this is a key inflection level where there was a fierce battle between the bulls and the bears in the last 2 to 3 sessions. All right, so that's why this will be my pivotal support level. All right, 113.75. So as long as this minor pullback that may take shape during the start of the European session, given that the hourly RSI has just started to exit from the overbought level and has yet to come close to the oversold region, 113.75 to maintain this potential minor pullback. If it didn't break on the downside at 113.75, we will maintain our intraday trend bullish bias on the euro dollar to potentially see another round of impulsive up move sequence. First resistance level to watch, 114.80, which is the minor congestion area here of 22nd of April, confluencing with the 0.764 Fibo extension to the upside, taken from the start of this 13th of May low. We also indicate the start of this minor uptrend phase after the retest on the rising 50-day moving average above 114.80 may expose the next intermediate resistance at 115.65, which is defined by the one-time Fibo extension from the similar low of 13th of May, and as well as confluencing with the minor significant swing high of 21st of April. Only a bearish breakdown and an hourly close below 113.75 that would negate today's intraday trend bullish bias to kickstart another round of choppy minor corrective decline sequence to revisit the 20-day moving average, which is confluencing with the next near-term support zone at 130 figure slash 112.70. So we'll be using a tightened short-term pivotal support level at 113.75, notwithstanding there's a risk of a minor pullback that could take shape on during the European session, but we still maintain our intraday bullish bias after this potential minor pullback ends. Next up will be the sterling dollar. So the sterling dollar also hit our resistance level as expected, 133.555. And the hourly RSI hit the overbought level and starts to shape that we call it exit from the overbought level. So indicating also there's a risk of a minor pullback as the European start session kickstart later in today's today. First minor pullback support level to watch, 134.80 over here, which is the minor congestion area here at the start of the Asia session before that burst up. Short-term pivotal support remains unchanged at 134.20, given that there's no clear break above the 135.55 level, and also very close to the rising 20-day moving average as well. So 134.20 short-term pivotal support to maintain this intraday trend bullish bias after that potential minor pullback ends. Next resistance level to watch after 135.55 will be at 136.40. Only a push down and a bearish breakdown and an hourly close below 134.20 that would invalidate today's intraday trend bullish bias to kickstart another round of choppy corrective decline sequence, exposing the next near-term support level for sterling dollar at 133.70 followed by 133.10. Next up will be the Australia currency against the dollar, which is the Aussie dollar. So the Aussie dollar squeezed up yesterday, which is above the 200-day moving average as expected, before now coming to stage that pullback over here. All right, so what I'm going to do over here is that I will use 64.55 as my short-term pivotal support level, which is close to yesterday's bullish breakout point. Now, which is yesterday's bullish breakout level, now turns into a pullback support and so correspond to the 200-day moving average as well. So 64.55 short-term pivotal support level, intraday bullish bias for today on the Aussie dollar. Near-term resistance level to watch will be the minor swing high of 26th of May, 65.37 slash 65.45. So 65.45 is this congestion area over here, which is the minor swing high of 14th of November and 25th of November last year. only a hourly close and a bearish breakdown below 64.55 that would invalidate yesterday's short-term bullish breakout scenario to see another round of choppy price movement on the Aussie dollar to actually trade back down within this complex sideways range configuration. Lower limit retesting 64.07, which is the minor swing low area of 29th of May and 30th of May. A breakdown below 64.07 exposes 63.65/63.50, which is the lower limit of that sideways range configuration, all right, over here, and also correspond to the rising 50-day moving average as well. Okay, so that's for the Aussie dollar using 64.55 as my short-term pivotal support level for today, and we will have a intraday trend bullish bias within this sideways range configuration with the upper limit as my intermediate resistance level to watch for today at 65.37/65.45. Next up, dollar yen. Right, so dollar yen plummeted down as expected, hit our support level 42.35. The RSI tracing out a bullish divergence, and it hasn't hit the overbought level yet. So right now we are potentially in the midst of a potential minor counter trend rebound sequence that may take shape during the European session and perhaps stretching into the start of the US session today. So with that, we will flip to a intraday bullish bias for this potential minor corrective rebound sequence to play out within its short-term downtrend phase. Why the downtrend phase is still intact? Because price action is way below the 20-day, is still below the 20-day and the 50-day moving average, and the 20-day moving average is below the 50-day moving average, indicating that the trend condition remains on the bearish side of the story. And we know that from a technical analysis perspective, price action don't go vertical up, vertical down, they oscillate within trend. So right now is a minor rebound oscillation phase that could be taking shape in the dollar yen using 42.35 as my short-term pivotal support level. Resistance level to watch on the short-term intraday basis for today will be at 144.25/80, which is this congestion area here, and the minor swing high of 30th of May that got rejected, that stage, that sell off yesterday, and also correspond to the 20-day moving average as well on the upper limit at 144.80. So I'll be watching very closely for bearish reversal candlestick at 144.25/80 to flip back to a intraday bearish bias when the time comes, perhaps around the US session thereafter, given the potential trajectory that it could take today. So that's for the dollar yen. However, if price plunges suddenly at the start of the European session with a bearish breakdown and hourly close below 142.35, then this intraday corrective rebound sequence will be invalidated to resume the bearish scenario for the dollar yen to expose the next near-term support level at 141.65/140 figure/140.90. In graphical terms will be the minor swing low of 23rd of April and the minor congestion area of 21st of April to 22nd of April. In Fibo extension terms, taken from this ongoing impulsive downward sequence since the start of this minor down move, impulsive down move from the high of 29th of May, project it up to the Friday rebound that confluence with the one-time Fibo extension and a 1.236 Fibo extension on the downside. Right, so that's sum up the intraday technical outlook for the FX market. Let us now turn our focus to the major stock indices, starting with the Hong Kong 33. So yesterday, despite Hong Kong 33 plunge, we didn't very convincingly flip to a bearish stance. Why? Because the 50-day moving average is still holding as a support level where we turn neutral between 23.70 and 22.680. So right now we start to see a pierce up in the intraday movement on the Hong Kong 33 starting from the US session yesterday, and right now we have a positive feedback look back into the Asia session. So with this positive price movement on the Asia session, we are now more confident to flip back into a intraday trend bullish bias on the Hong Kong 33, representing the Hang Seng Index over here. But nevertheless, there could be a minor pullback in the second half of the session as the hourly RSI has already hit the overbought level, and price action now is hovering just below our first resistance level at 23,600 level. So what we have over here is that we will have a tighten short-term pivotal support level around this zone over here at 23,200 / 23,070, which is also corresponding very closely to the 200-day moving 20-day moving average as well, pardon me. I think as a key near-term support level. So as long as this minor pullback then appears below 23,200 / 070, we will flip back to an intraday trend bullish bias for a recovery scenario on the Hong Kong 33. Above 23,600 may see 23,970 / 24,040 next. We also confluence with the minor swing high area of 21st of May. However, if price action starts to break down again below 23,070, then we have a choppy downward drift to retest the 50-day moving average, I think, as a key next near key intermediate support level next at 22,680. All right, so flipping to a intraday trend bullish bias after a potential minor pullback that could take shape in the second half of the Asia session, using 23,200 / 070 as my short-term pivotal support zone for the Hong Kong 33. Next up will be the Japan 225, representing the Nikkei 225. So the Nikkei 225 managed to come down, hit our first support level before staging a bounce up above the 20-day moving average again, but can't surpass above the 200-day moving average before staging a minor pullback as we are speaking right now. Interestingly, yesterday's slide to print lower low, hitting the support level at 37,270, correspond with a bullish divergence condition at the hourly RSI indicator, indicating the lack of downside momentum that has is now showing up on the Japan 225. So with this positive bullish divergence signal that has taken shape after price action hit our support level at 37,270, so I'll be using this 37,270 37,270 as my short-term pivotal support level. We'll flip to a intraday trend bullish bias for a potential recovery scenario on the Japan 225. First resistance level to watch for sure, 37,980, which correspond to the 200-day moving average. Only a breakout above 37,980 may gain more traction for the bulls to expose the next intermediate resistance level at 38,460, which is the minor swing high of 29th of May. Only a bearish breakdown and the hourly close below 37,270 will negate today's intraday trend bullish bias and invalidate the recovery scenario to see a further slide down towards 37,930. A breakdown below it may revisit the minor swing low of 23rd of May at 36,450, which also corresponds pretty much closely to the 50-day moving average. So that's for the Japan 225. Next up will be the Germany 30. So Germany 30, yesterday's intraday technical elements, while we were doing that intraday technical outlook yesterday, were rather mixed. So we flipped to a neutrality stance instead. But instead, the price action yesterday came down to a lower limit of our neutrality stance, which is 23,670, and also right at the 20-day moving average. The hourly RSI starts to print out a bullish divergence as price action drift downwards lower yesterday, where the hourly RSI shaped a higher low instead. So indicating that downside momentum has started to ease out on an intraday basis. So with that, that is a positive element. So we will be more confident for today to flip back to a intraday trend bullish bias stance on the Germany 30 using 23,675 as my short-term pivotal support level and a clearance above the upside trigger level for today, which was rejected on Friday, which is 24,125, potentially sees the increased chance of this bullish impulsive up move that may resume to expose the next resistance zone, which is defined by Fibo extension clustering levels at 24,440 / 24,560. Only a bearish breakdown and an hourly close below 23,675 will invalidate today's intraday trend bullish bias to trigger off a minor corrective decline sequence, revisiting the minor swing low area of 23rd of May, the 15th of May, and as well as 12th of May, acting as the next intermediate support level at 23,380. Only a breakdown below 23,380 may see a deeper corrective pullback towards 22,910, which correspond to the rising 50-day moving average. Next up will be the major US stock indices, we call it Kickstarting with the US Wall Street 30 representing the Dow Jones Industrial Average. So yesterday the Dow Jones Industrial Average continues to track within this range over here between the 20-day and the 200-day moving average. So RSI is rather mixed as well, neither here nor there, what we could see over here. So we will still maintain our neutrality stance for today on the US Wall Street 30, 42,440, 41,850. All right, for the to potentially trade in the sideways range again on the US Wall Street 30. Lastly will be the Nasdaq 100. So the Nasdaq 100 yesterday push up hit the resistance level at 21,500, and right now we see the RSI exiting from the overbought level. Okay, so potentially it may now see a bit of stalling or sideways movement on the Nasdaq 100 within this below the short-term pivotal resistance that we have yesterday at 21,500, and this 21,500 also correspond to the pullback resistance of this former medium-term ascending trend line support that I drew from the low of 7th of April. All right, so watching very closely the 21,500 short-term pivotal resistance level, maintaining have that intraday bearish bias for a potential minor pullback. First support level to watch will be the 21,180/21,015 level, which confluence with the rising 20-day moving average. So if there's any sign of a bullish candlestick that appears in this key near-term support zone level at 21,180/015, potentially there could be the start of a new impulsive up move sequence for the Nasdaq 100. All right, so at this moment in time, from a technical analysis perspective, it's more of a minor pullback rather than the start of a multi-day down move, corrective down move sequence. All right, so watching the 21,500 short-term pivotal resistance level for this potential minor corrective pullback to play out towards the 21,180/15 key short-term support level. However, if price action starts to have an hourly close above 21,500, then this minor pullback corrective sequence will be invalidated to kickstart another round of impulsive up move sequence, revisiting 21,750. Above it, may see it probing up towards the all-time high area at 22,200/22,250 next. So that's for the intraday technical outlook on the Nasdaq 100 and the major stock indices. Let us now turn our attention to the commodities market, starting with gold XAU/USD. So gold XAU especially burst towards the upside as expected, hit surpass our first resistance level at 3,370 right over here. This will be surpass. So now the RSI really hit the overbought level, and right now as we are speaking, it started to exit from the overbought level, indicating some form of minor pullback as the European session unfold thereafter. So potentially minor pullback levels to watch on the first level will be 3,328. Pivotal support level will be at 3,300, which confluence with the 20-day moving average, and as well as the pullback of this upper limit of this bearish flag that I drew from the high of 23rd of May now turns into a pullback support at around 3,300 level as well. So as long as this minor pullback later that may take shape in the European session don't surpass below 3,300 tighten short-term pivotal support for today, we'll still maintain our intraday trend bullish bias on gold XAU/USD. Intraday resistance level to watch for today will be 34.17, pardon me, 34.35, which is the 0.764 Fibo extension to the upside taken from the low of 15th of May, and as well as the minor swing high area of 7th of May and 8th of May. However, if price action starts to break down for hourly close below 3,300, today's intraday bullish bias will be negated to kickstart a choppy corrective decline sequence back down towards 3,252, which correspond to the rising 50-day moving average, and as well as the minor swing low that kickstarted this minor impulsive up move sequence since last Thursday. A breakdown below 32.52 may expose a deeper corrective pullback towards 3,220/204, which also correspond to the medium-term ascending trend line from the low of 31st of December last year. All right, lastly will be the West Texas oil. So the West Texas oil yesterday squeezed up over here and now but managed to actually stage that bearish reaction of the 64.06 short-term pivotal resistance level. So this is indeed a pivotal resistance level that managed to cap yesterday's bullish tone. And what's interesting over here is that the hourly RSI has hit the overbought level and print a series of lower high. All right, so still no change, still watching pretty much closely. 61.06 as my short-term pivotal resistance level for oil to actually remains congested in this sideways symmetrical triangle range configuration since the low of 9th of April. And right now it could potentially shape a minor a drop or pullback back towards the 20-day moving average, which also correspond to yesterday gap up support level at 61.85. A breakdown below 61.85 may revisit last Friday minor swing low area at 60.35. However, if price action starts to squeeze up and a bullish breakout for hourly close above 64.06, today's intraday bearish bias will be invalidated to see the extension of this corrective rebound, exposing the next intermediate resistance at 65.40, which is the minor swing high area of 23rd of April. All right, so that sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for as we head into the European session thereafter? 5 p.m. Singapore time will be pretty much important. That's the core inflation preliminary rate or flash rate in Eurozone market for the month of May. So market is expecting a slowdown to 2.5% year on year from 2.6% year on year that was printed in the previous month of April. So that could potentially impact the Germany 30 and as well as the Euro dollar and the Euro crosses. Then next up, we have tier 2 job data from US jobs, JOLDS jobs openings at 10 p.m. Singapore time, something to look out for. And we have a slew of Federal Reserve officials speaking as we head into the early session of Wednesday, 12:45 a.m. Singapore time Fed Goolsbee, 1 a.m. Singapore time Fed Cook, and 3:30 a.m. Singapore time Fed Logan speech. All right, so that should potentially that sum up the intraday. That sum up the today's daily dose of market insights. I'm Kelvin here, signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.